Imagine waking up tomorrow, unlocking your phone, and seeing a number that instantly makes your chest feel heavy. Gold at $5,300, silver surging past 115, and the S&P 500 sitting at 7,000. Even while everything around you feels more expensive, more fragile, and more unstable than ever before, this wouldn't be a victory headline. It would be a warning. Because moments like this don't appear out of nowhere. They arrive quietly after years of inflation, debt, and money printing building pressure beneath the surface. What you're about to hear isn't hype, and it isn't fear-mongering. It's the real story of money, power, inflation, and the slow-motion tsunami already forming inside the U.S. financial system, whether most people see it yet or not. Before we go any further, if you value clear, honest breakdowns of gold, silver, inflation, and the global economy, make sure you subscribe to Bullion Alert HQ right now. This channel exists to cut through the noise and explain what's really happening behind the headlines, without drama and without distraction. Hit subscribe and turn on notifications, because what we're about to unpack today is something every American should understand. Now let's start with a simple question that doesn't get asked nearly enough. How can stock markets keep hitting record highs while everyday life keeps getting harder? Gas costs more, groceries cost more, rent, insurance, healthcare, and education all keep climbing. Yet at the same time, the S&P 500 pushes higher, retirement accounts look stronger on paper, and financial media celebrates new milestones like they're proof that everything is fine. This disconnect isn't accidental. It's the natural result of inflation, debt, and money creation colliding in a way the modern economy has never experienced before. Inflation isn't just about higher prices. It's the slow, silent erosion of purchasing power. When the dollar loses value, everything priced in dollars appears to rise. Food, housing, stocks, and especially hard assets like gold and silver. Over the past decade, the United States has printed and borrowed money at historic levels. Trillions of dollars were created almost overnight during crises, and instead of being reversed, that easy money quietly became permanent. What started as emergency support slowly turned into the new normal. At first, inflation was called temporary. Then it was described as manageable. Now it's becoming structural. Even when inflation numbers appear to cool, the cost of living doesn't come back down. Wages struggle to keep pace. Savings lose purchasing power, and households rely more on credit just to maintain the same standard of living. Credit cards, auto loans, and personal debt continue to rise, not because people are careless, but because money simply doesn't stretch the way it used to. This is where gold and silver re-enter the conversation. For thousands of years, these metals have served one core purpose: protecting purchasing power when paper money weakens. They don't depend on governments, they don't rely on interest rates, and they can't be printed into existence. When confidence in fiat currency starts to crack, gold and silver tend to respond, sometimes gradually and sometimes all at once. The idea of gold reaching $5,300 and silver touching 115 may sound extreme today, just like $1,000 gold once sounded impossible. But history shows that the biggest moves in precious metals rarely happen during calm, stable periods. They happen during times of monetary stress. And right now, that stress is quietly building across the entire global financial system. Central banks around the world are trapped. If they raise interest rates too high, debt becomes unmanageable, markets begin to crack, and governments struggle to service what they owe. If they cut rates too soon, inflation reignites and currencies weaken further. This isn't theory. It's a real-time dilemma playing out behind closed doors. And when policymakers are trapped, assets that exist outside the system tend to shine. At the same time, global demand for gold is quietly accelerating. Central banks themselves are buying at record levels, especially in regions looking to reduce their dependence on the US dollar. This isn't coincidence, it's preparation. When the institutions closest to the monetary system start choosing hard assets over paper promises, it sends a signal that's hard to ignore. Silver adds another powerful layer to this story. Unlike gold, silver isn't just money, it's also an industrial metal. It's critical for solar panels, electric vehicles, medical technology, and modern electronics. Demand keeps rising, while supply struggles to keep up. Above-ground silver inventories are shrinking, and new discoveries aren't arriving fast enough. When investment demand and industrial demand collide, price moves can become sudden and explosive. Now let's talk about the S&P 500 reaching 7,000. On the surface, it looks like strength, but when you look closer, you see something else entirely. Much of the market's rise is driven by inflation itself. When the dollar weakens, asset prices inflate. Stocks don't always rise because companies are healthier. Often, they rise because the measuring stick, the dollar, is losing value. This creates the illusion of wealth. Portfolios look larger, account balances grow, but the real question is what those dollars can actually buy. If your investments double while living costs triple, you're not really ahead. This is one of the most dangerous psychological traps in modern finance. The inflation tsunami doesn't arrive all at once. It comes in waves. First, asset prices rise. Then living costs increase, then debt expands. Finally, confidence begins to crack. Right now, we appear to be somewhere between the second and third wave, and the fourth is the one most people aren't prepared for. Historically, when inflation becomes entrenched, governments respond with more spending, not less. Cutting spending is politically painful. Raising taxes is unpopular. Printing money is easy. And every time that choice is made, the system moves a little closer to its breaking point. Gold and silver don't predict the future. They reflect the present. And what they're reflecting right now is a world drowning in debt, addicted to liquidity, and increasingly unsure about the long-term value of paper currencies. That's why price targets that once sounded absurd are now being discussed seriously. Not because gold is magically becoming more valuable, but because money itself is being diluted. A $5,000 gold price doesn't mean gold has changed. It means the dollar has. If you're finding this breakdown useful so far, take a moment to like this video. It helps Bullion Alert HQ reach more people who are trying to understand what's really happening beneath the surface of the economy. Another factor few people talk about is trust. Markets run on confidence, currency runs on belief, and belief is fragile. When people start questioning whether the system truly works for them, behavior changes. Savings move, spending shifts, safe havens become attractive again. You can already see this in subtle ways. Younger generations feel less confident in traditional retirement systems. Home ownership feels out of reach for many. Faith in long-term stability is weaker than it was decades ago. These social signals matter because economics is ultimately human behavior at scale. When fear arrives, suddenly markets panic. But when fear grows slowly, it reshapes decisions quietly. That's the environment where gold and silver tend to thrive. None of this means the system collapses overnight. It means we enter a long period of adjustment where volatility becomes normal, purchasing power continues to erode, and those who prepared early sleep better than those who didn't. The real danger isn't a market crash. It's complacency. It's assuming tomorrow will look like yesterday. It's trusting that numbers on a screen automatically equal security. Gold at 5,300 and silver at 115 aren't signs of prosperity. They're warning signals. They're thermometers measuring the fever inside the financial system. As we move forward, pay close attention to what policymakers do, not just what they say. Watch central bank balance sheets, watch debt levels, watch currency strength, and most importantly, watch behavior. When behavior changes, the narrative always follows. We're entering a decade where understanding money matters more than ever. And here at Bullion Alert HQ, our goal is to help you stay informed, calm, and prepared. Not scared, not hyped, and not caught off guard. As we wrap up, I'd love to hear your thoughts. Do you believe gold and silver are headed much higher? Or do you think the system can still stabilize without major consequences? Drop your perspective in the comments below. Your insight helps drive future conversations on this channel. And if you found value in this video, share it with someone who needs to hear it. These conversations matter, especially when so much noise distracts from what truly matters. Thanks for watching Bullion Alert HQ. Stay curious, stay informed, and I'll see you in the next one.